Coming up on Business Incorporated today. Kenya's finance minister says economy to grow under 2.5% this year. Sudan declares state of economic emergency due to currency pressure. South African Airways needs state cash by the end of next week. Hello and welcome to Business Incorporated. I'm Tempula Shaju. Let's get the show started with some major numbers from around Africa, where investor sentiments in the continents were mixed at intraday as South Africa's JSE rose 0.58%, while Nigeria's main index declined marginally by 0.03%. The market in Egypt closed sharply higher by 1.29% on Thursday, ending two sessions of losses as most of its constituents were in the positive territory. And Kenya closed higher on Thursday, the last trading day, as the market made some recovery. Major markets in the Middle East closed for the week mostly positive Thursday, except the index in Dubai, which lost 0.14%, with Sharia-compliant lender Dubai Islamic Bank and blue-chip developer Emir Properties falling 0.7% each. In Abu Dhabi, the index added 0.23%, helped by a 0.4% gain in the country's largest lender, First Abu Dhabi Bank. And elsewhere in the region, the Qatari index gained 0.53%, while Saudi Arabia's main index added 0.69%. European markets were mixed from Friday as investors monitored tense negotiations between the United Kingdom and the European Union. Let's cross over to Frankfurt Stock Exchange, where Conrad Bussen is standing by to tell us more. Hi, Conrad. We know that the stock markets in Europe are about to be ending the week with a weekly gain, supported mainly by the European Central Bank's decision not to change its interest rates or its quantitative easing strategies. But how long are interest rates in the euro area going to stay at these record low levels?
Well, Temple, I think it's a fair guess to say for a very, very long time. If you look at the consumer price inflation target the European Central Bank has, this 2% target, well, in August, consumer prices in the countries of the euro did not rise at all. They contracted by 0.2%. So as long as nothing very surprising happens in terms of price developments, or as long as the European Central Bank doesn't reconsider its consumer price inflation target, there is no need to even think about changing interest rates from the European Central Bank. Today, I think it's also worth mentioning something else that was mentioned after the European Central Bank's Council meeting yesterday. Because, you know, the euro-dollar exchange rate is relatively high, and there's been all this discussion about potential manipulating of the currency by our central bank. Christine Lagarde, the ECB chief, yesterday said that yes, the ECB is keeping an eye on the exchange rate because it has an impact on inflation, but the ECB does not have an official exchange rate target. And that's important, of course, because it underlines that it's the market that makes this exchange rate, that it expresses the underlying economic situations in both the US and America, and that there's no manipulative activity behind it.
There's a whole lot of exchange rate issues all around the world at this point in time. Conrad, I bet you know that. But we know that the government of the United Kingdom has announced it has struck a kind of a trade agreement with Japan, preparing for the times after Brexit. What's the outlook for the talks between the UK and the EU at this point?
Well, the outlook is very negative, I have to say, because the Brits are not willing to stick to the withdrawal agreement that has been struck between the UK and Europe a while ago, struck, signed and decided on. But the UK has decided that it does not want to stick to the details of this contract. It has to be said that the Brits don't stick to their word. They're not willing to fulfill the requirements of an international deal it has struck. So There, I have to say, are also a few doubts out there whether today's deal struck between the UK and Japan is really a big success. Basically, it confirms to the United Kingdom, or the Japanese confirm to the United Kingdom what they already confirmed to the European Union under the current EU-Japan agreement. And of course, it's absolutely unclear whether all the details will really be agreed as they are intended by the Brits. It is a fundamental agreement, and there are no details, or not many of them, out yet.
Well, it's all about governments. Let's hope that they will have a kind of a meeting point somewhere. It's going to happen. We're so sure of that. Well, let's move on now. We know that Brexit also seems to have an impact on the landscape of stock exchanges in Europe, as the London Stock Exchange is now selling its holding of the Italian Stock Exchange in Milan. Can you tell us who's buying that?
Well, there's a lot of speculation about this in all of the financial centers of Europe. What I can tell you is that one official offer is out now. They're not mentioning prices, but Euronext, the stock exchange operator based in Amsterdam with many ties to other European bourses, it has joined forces with an Italian bank, CDP, to take over the Italian stock exchange. The rumor is that they are willing to pay between 3.5 and 4 billion euros. Whether or not this is going to be enough remains to be seen, because two other stock exchange operators are rumored to be interested in making an offer for the Italian bourse, and that's the Deutsche Börse, the German stock exchange operator here in Frankfurt, and the Swiss operator of the stock exchange in Zurich. Both are rumored to be interested too. So now, at the moment, the financial communities in Europe, they're sort of getting prepared for interesting and maybe long takeover battle.
We'll keep our eyes on that story because we know that there is opportunities for demutualized stock exchange. It gives room for entry and exit. Conrad, thank you for your insight and analysis on the show. I appreciate them. Let's head over to the United Kingdom now, where the government has struck its first major post-Brexit trade deal. Juliana Olayinka, our colleague, is standing by to tell us more. Hi, Julie. The UK has now reached an agreement with Japan, clinching its first major post-Brexit trade deal. Can you tell us what this agreement entails and how big a success it is for Boris Johnson, the Prime Minister?
Good afternoon, Temple. Well, it's definitely some much needed light relief for Prime Minister Boris Johnson, because as the whole world knows, he's had a pretty intense week. This is the first trade deal struck for the unknown post-Brexit era when it begins January the 1st, 2021. It is with Japan, and what this deal will ensure is that 99% of trade between Japan and Britain will be without any tariffs. It will be tariff-free. Now, of course, since the UK left the EU on the 31st of January, their main goal has been going around the world trying to strike these free trade deals. That's exactly what Brexit was supposed to be about, Britain launching itself into the world without the EU. But I've got to say, I agree with much of what Conrad was just saying in Frankfurt. Some people are saying, OK, is it really much of a big deal? At the moment, trade between Japan and the UK currently stands at just 2%. So what we're expecting is that this will contribute less than 1% to British GDP, 0.07%. And it basically parallels the existing trade agreement that Britain has with Japan under the EU. So, of course, it is a historic day. We have actually got a statement from Liz Truss, one of the trade ministers. She says this is a historic moment for the UK and Japan, our first major post-Brexit trade deal. The agreement we've negotiated in record time and in challenging circumstances goes far beyond the existing EU deal. I'm not sure everyone would agree with that. The deal will cover all sectors, well, most sectors, food and drink, finance and tech. So British pork, beef and salmon from Britain can get into Japan, and they won't have to pay a dime on that.
Right, Juliana. Still talking post-Brexit. Talks over a trade deal with the EU are hanging in the balance at this point amid a standoff over the UK's plan to override part of the Brexit withdrawal agreement. What's this all about?
Well, this is all about the major issue, Brexit, and this withdrawal agreement and the internal market bill. Again, just to repeat much of what's already been said on this programme, the EU agreed to the withdrawal agreement that nobody thought the EU would agree to last year. This agreement would keep Northern Ireland aligned with some EU regulations. The government have been sitting on this for months, and they have decided in the final hour, just before the 8th round of negotiations started with Brussels this week, that deal is not good enough, and they want to tweak parts of it to ensure that Northern Ireland remains wholly part of the United Kingdom. And of course, this is receiving mounting anger. We heard from Nancy Pelosi in America saying that, you know, if Boris Johnson goes ahead with this, you can forget a free trade deal with America. We've heard from 3 former Conservative leaders, Sir John Major, Lord Michael Howard and Theresa May. And we've also heard, we're hearing increasing anger from Tory, I would say, faithfuls, people that are pretty loyal to Boris Johnson. They're not happy about it. Is it going to even pass into legislation? I'm not even sure. Next week, it will go for a pretty historic vote in the House of Commons. Even if it does pass through the House of Commons, again, there are some senior figures in the House of Lords that are not happy with it. To go back to the legal part, we do know there are several senior officials from Brussels in London at the moment, and they did speak to the UK. They urged them to not put this new legislation into a vote in the House of Commons next week. Michael Gove, who's speaking really on behalf of the entire Brexit transition, he said, quite frankly, no, that Britain will not and could not change their mind on this. So they are planning to go ahead and break this international treaty. And yes, it's causing a storm, not just here, but across the shores.
It must be one of those decisions of government that traders and dealers across markets will be watching. But let's talk more about the numbers crunching today at the London Stock Exchange where you are. How are the markets reacting to the GDP numbers released earlier this morning? It was a little bit of a positive 6.6% or thereabout. But do they see that as some kind of a step in the right direction or not?
It is a step in the right direction, but to be honest with you, it only made a fizzle on the FTSE at early trade. But we are ending the week in positive territory, which is a good thing. And I think the sentiment really at intraday, Temple, has been pushed up by this new trade deal that Britain has struck with Japan. The FTSE all-share is up 0.28%. The FTSE 100 is up by 0.33%. And the FTSE 250, the domestic market, is up by 0.22%. In currencies, the pound is down on the US dollar by 0.09%, down on the euro by 0.55%, and down on the Japanese yen by 0.03% at intraday.
Right, Juliana, thank you for your time and do have a wonderful afternoon over there. So stocks in Asia Pacific were mostly higher on Friday as investors watched regional technology stock movements following the decline in the sector. Mainland Chinese stocks were higher by their close, with the Shanghai Composite up some 0.79%, while the Shenzhen Component rose 1.57%. And Hong Kong's Hang Seng Index advanced 0.78% to end its trading day at 24,503.31, while South Korea's Kospi finished its trading day little changed at 2,396.69. And elsewhere, Japanese stocks saw gains on the day as the Nikkei 225 rose 0.74%, while the Topix Index advanced 0.72% to 1,636.64. Meanwhile, Australia's ASX 200 fell by 0.83%. And U.S. stocks futures traded higher earlier Friday after a volatile session in which the recent tech sell-off resumed. Dow Jones Industrial Average futures implied an opening gain of more than 150 points, while the Standard & Poor's 500 futures and Nasdaq 100 futures, both traded in positive territory. The Dow ended Thursday's session down more than 1%, along with the S&P 500. We'll bring you more stories from Africa when we return from this short time out. Stay with us. Welcome back to Business Incorporated. Kenya's finance minister says the economy is expected to grow less than 2.5% this year as the country continues to reel from the effects of COVID-19 pandemic. However, growth is expected to rebound to 6% in the medium term. According to the minister, interest and exchange rate stability will be safeguarded over the medium term, while inflation is expected to be contained within 2.5 and 5% band. And Sudan has declared an economic state of emergency after its currency fell sharply in recent weeks due to systemic vandalism. The transitional government in charge of Sudan, since Omar al-Bashir was ousted last year, will set up special courts to fight smuggling and other illicit activities undermining the economy. The pound had fluctuated in recent days, prompting major food suppliers to halt distribution of their products and pushing prices of foods up between 50% and 100% at supermarkets and retailers. And South African Airways needs short-term funding from the government by the end of next week for the state carrier's business rescue process to continue. Now, the administrators say the existing funds available are for operational expenditure and are nearly depleted. The administrators took control of SAA in December after almost a decade of financial losses and published their restructuring plan for the airline in June, following repeated delays and wrangling over its future. And from President Cyril Ramaphosa to economic analysts and workers' unions, reactions have been trailing South Africa's second quarter GDP figures, which showed a fourth consecutive negative growth. In a statement, President Ramaphosa says this decline in GDP reflected the severe impact of the global coronavirus pandemic on the economy, and it should spur all South Africans to do all they can do to help rebuild the economy. We also spoke to some economic analysts on what they make of the figures released by the nation's Statistician General.
The 16.4% decline in the second quarter is the fourth consecutive decline in quarterly GDP since the second quarter of 2019. The manufacturing industry contracted by 74.9%. The trade, catering and accommodation industry decreased by 67.6%. Transport, storage and communication went down by 67.9%, while the finance, real estate and business services industry decreased by 28.9%.
The economy of our country decreased by 51%. Unadjusted year on year in quarter two, it dropped by 17.1%. And of course, 6 months on 6 months, unadjusted, it's sitting at negative 8.7%.
The agriculture, forestry and fishing industry was the only positive contributor to GDP growth, with an increase of 15.1% and a contribution of 0.3% to the whole. The increase was mainly due to increased production of field crops and horticultural and animal products. The mining quarrying industry also decreased by 73.1% and contributed minus 6.0 percentage points to GDP growth. Economists say the decline is not a surprise, especially as it came during the hard lockdown in the country.
No one is surprised about that because we do know exactly how it happened. There was a general shutdown of economic activity in response to the healthcare crisis. And of course, a lot of productive sectors of the economy then had to either stop production altogether or do it at a significantly reduced scale.
So on the whole, was it expected? Yes. The extent of the decline is far worse. I think because of the quarter-on-quarter data being released, you'll have to see the annualized figures year on year to see the full effect. but I think that it's an indication that we definitely have been significantly hit, much more than most African economies and other larger economies that have released quarterly data in terms of nominal GDP.
Expenditure on real gross domestic product fell by 52.3%. Household final consumption expenditure decreased by 49.8%, contributing minus 30.8 percentage points to total growth. Stats SA says household spending decline is as a result of the closure of hotels, restaurants, transport services, recreational facilities, and many stores. The ban on alcohol and cigarette sales had an impact on household expenditure as well. We asked the question, how far or near is any likely recovery?
The long-term recovery of the economy will take much more than 24-month period. We have to have in place measures to mitigate both the short and long-term structural issues, but the short-term issues should be really to stimulate and try to stabilize some of the shock effects that we are seeing.
This is the first time since South Africa restored multiracial democracy in 1994 that its economy will experience 4 consecutive contractions. The outlook seems mostly bleak, but as part of efforts to change that, President Cyril Ramaphosa has announced that social partners will soon present a social compact on economic recovery. Also, a presidential employment stimulus initiative will be implemented from next month to expand employment opportunities and counteract job losses.
And once one of the largest exporters of wine to Europe, Algeria, is trying to revive its historic production of the alcoholic drink and to support local producers. Well, we know that farmers in Algerian countryside fill large crates with juicy red and green grapes, later to be fermented into wine at a nearby factory.
In the Algerian countryside, farmers can be seen filling large crates with juicy red and green grapes, later to be fermented into wine at a nearby factory. Algeria country is trying to revive its historic production of the alcoholic drink and support local producers.
Here in Algeria, we used to be among the world's premier wine exporters. We used to produce about 22 million hectolitres during the 40s, 50s and 60s. But now, we've lost the market.
The winery and vineyard are located in Sidi Bel Abbès province in western Algeria, once a center of the industry, being a stronghold of the armed Islamists during the country's decade-long war in the 1990s, when production in Sidi Bel Abbès came to a near halt. But the businessman who owns the Spavie Wine Company with his brother said they're working hard to recapture the market.
We want to revive it, but we need help from the government to plant the grapes. We can't keep up with the demand. We have the local market and the external market to think of.
The company, which was founded in 2004, uses around 40 oat cellars for creating their wines, which they believe produce a unique quality of the drink.
The old traditional wine are better than the new ones. The new ones leak. This one has been used since 1939 and is still in good condition.
In July, the government said that Algeria's economy contracted 3.9% in the first quarter this year, after a 1.3% growth in the same period in 2019, weakened by the coronavirus lockdown and a bad performance by the vital oil and gas sector. Growth in almost all sectors has been weakened since the authorities imposed a lockdown earlier this year aimed at curbing the spread of the coronavirus. The government says that a new social and economic revival plan is due to be announced next month.
Wines for the weekend. Well, that's the show for today. Thank you so much for being a part of it. I'm Temple Ashaju. I'll see you next time. Bye for now.